Cool. How are we all today? Welcome to January. Welcome to our first live of the year. I'm really excited this year. We've got the whole year, 48 weeks here to put everything together. Over the next 20, 30 minutes, I just want to work off the basis of where you guys are at. So I'm just going to wait for a few more people to join us tonight. Just waiting for a couple more and then we'll get started, guys. So I hope everyone's had a good start to the year. Feel free to comment any questions, of course, throughout the night. The next 20, 30 minutes, we're just going through this. This probably is the most important part before investing, before doing much actually, is just understanding where your value is as far goes as investing, but also about where you want to head to. So tonight I'm going to go through some figures. G'day Leanne, g'day Jess. I'm going to go through some figures tonight and just go through an example of a client that I've already done this for. It was late last year, but I just want to go through, basically what you're worth, go through how you work out a budget and work out what you need to be financially independent. It might shock some people, but it's good to know because it's very, very important. So whether you're watching this now or whether you're whether you're watching this live or you're watching this tonight, tomorrow, whenever, feel free to comment. We still answer comments down the track, but also feel free to reach out to us if you ever have any questions as well. So calculating your net worth. So guys, what I wanted to go through today is working out what you're worth as far as retirement planning or property planning or financial independence planning goes. So what we've got to work out first. So I did say on my live last week just to have a pen and paper handy. If you haven't, that's okay. Just re-watch it so you can work out all these costings for yourselves, and then we work it backwards from there. So let's get started, guys. So the first thing we have to work out to calculate your net worth is what your assets are and what your liabilities are. Now, I've written everything up. Now, with my actual real figures, I don't have numbers to fill in every gap, but I've written these up for you guys more than me, just so you know what to allow for when it comes to liabilities. So I'm going to start with liabilities first and then come back and do assets after. So, all right, so simple thing, I've got my numbers on my board here. Okay, so their home loan. So with these guys, we've got the home loan is $250,000. This is their initial liability. They have two investment properties. One has a loan of $500,000 and one has a loan of $350,000. Lucky enough for these guys, any other debts they have, there's not that much. So when you're going through your liabilities, you want to make sure you've taken into consideration car loans, personal loans, business loans. Some people have tax debts, some people have HEX debts. I think it's called help debt now, actually. And of course, you've got the dreaded old credit card. Anyone who knows me or is a client of mine probably is aware that I'm a massive hater of credit cards and Afterpay. Please don't do Afterpay, ZipPay. Please avoid all that sort of stuff. So with these guys, just so I'm going to do a full scenario so you guys know how to work it out. These guys have a car loan of $8,000 and they also have a credit card of $12,000. They don't have any of the other, but that's okay. You might, so add it all in there, guys. So if you're writing it down as we go and you have questions as we go, feel free to pop it in the comments, all right? All right, so with these guys, with their full liabilities, as with what we have here, they have liabilities of $1,120,000. Now, that's their liabilities. Now we've got to work out their asset base. So with their asset base, we're going to work it from top to bottom, and I'm going to explain to you a little bit about the asset base and what I do different to other people. So their home is worth $900,000. They've got two investment properties. One's worth $650,000 and the other is worth $580,000. Now all these are round numbers, of course, as well. Now they've got cash in their offset account. Now if you have a home loan and don't have an offset account, you really need to chat to your bank about that. They've got $65,000 cash in their offset account. They had some shares, so they've got $15,000 in shares. They've also got $180,000 in super. Now this is a couple, this isn't a single person, this is two people, like husband and wife. Obviously they don't have any business debts because they don't have their own business, But then I have got down here collectibles. So say for example, you have stamp collection, coin collection, car collection, whatever. If you've got collectibles that are worth a value, you can put them in here as an asset. But if you want to use them to calculate your net worth as far as retirement planning goes, or as far goes as say financial independence, you've got to realize for you to make true value out of these collectibles, you're going to have to sell them. So say for example, you have a beautiful car, it's worth $100,000 and as a collectible, and you're not going to sell it as part of your basically replacement of income, don't put it in there. Like say for example, my cars, they will never go in there because they're never getting sold. I only sell cars if I really have to, but I would not do that for that reason. So with these guys, this guy's asset value is $1,490,000. Now, for you mathematicians out there, you will see I haven't included the home loan. So it's a two-way street here. We've got to be careful. So I don't include the home loan in your assets if that's where you're going to live for a fair bit. So if you've got young kids, you're going to be there for a while, do not include your home asset. If say, for example, you're older, your kids are left home, the house is too big and you're going to downsize to something cheaper, you could potentially use some of this home asset as part of regenerating into your retirement planning. So if, for example, you're going to downgrade your home from $900,000 to a $600,000 home, and you're going to have this, $300,000 tax-free cash, that can go in as part of your net worth. But if you don't do it. So say, for example, I've got clients in Sydney that might have paid 100 grand for a house and now it's worth sort of $2-3 million, and they're not going to stay there in retirement. So they might move somewhere a bit further afield, pay $1 million or $500,000, and their actual home base is going to become part of their portfolio when it comes to cash and capital at the other end. So that some people do it that way. I don't suggest to do it like that, to be honest, but some people just have that. They've just got that. So with these guys, their assets is 1.4, their liabilities is 1.12. So what their net worth is, their actual net worth is $370,000. Now that's including super. So another thing you've got to be aware of is if you're young and you want to retire or become financially independent prior to you accessing your super, you actually can't include that either because you can't get access to it. You might be able to some way, but realistically, you can't allow for it. So if you wanted to retire before retirement age or become financially independent before retirement age and you're adding more to super each week, you should have a chat to a financial planner to see if that's your best option. It might not be. So assets, liabilities, to start off with, these guys, their net worth is $370,000. Now, when we're looking at a basic example, now this is what we call, I'm going to go through this whole process, and this is what we call an inactive investor. So an active investor is when you're really hands-on with your investment portfolio. You're very involved and you do a lot of property transactions. An inactive investor is where they just want to invest and take passive income and not have to worry about day-to-day running of their investment portfolio. So depending on whether you're an inactive investor or an active investor, that will depend on how much capital you need to become financially independent. So I'm going to leave this up here, guys. I'm going to get rid of all this, but this is how we work out, take a bit of a screenshot on how I calculate my net worth. I do this every single January. Now, I'm not a New Year's resolution person at all, but January just seems to be the time of year for me where I can have a bit of a fresh head and I can just adjust on where I'm heading financially. And I just like to make sure my net value is continually increasing, and also my investment portfolio cash flow is also continually increasing. And those of you who know me, I did go through a divorce last year, and so that's dropped dramatically from a couple of years ago. So I'm way back into building this up again. So that's your net worth. Now, if, for example, we're looking at, this is what you had for retirement, what I normally work numbers on is a 5% return. That's an average sort of return. Now, obviously, if you put that money cash in the bank, you're not going to get that, but you could invest that 370 somewhere, whether it's property, shares, whatever it might be, and you should be able to obtain a 5% return on your money. And that's why I use 5% as an average. So if these guys wanted to shut up shop today and they wanted to retire with that $370,000, they're going to have a return per year of $18,500, which is nothing, right? That's nothing. So that would be their income today. That's terrible. So that's not going to do much for you whatsoever. Just let me wipe this board down, guys. Give me 2 seconds. And I'll go through the next part. The next part's about budgeting. So everyone loves budgeting. No one loves budgeting. So bear with me, guys. I'll just clean this board down. I need one of those electronic ones where you just hit the delete button, but I'm not paying for one of them things. All right. So the next thing is budget. So when we're looking at a budget, when I do budgets, I do them monthly. If you're paid weekly, fortnightly, or monthly, you may want to change this around compared to what your pay cycle is. It's like if you're paying your home loan. If you're paid monthly and you're paying your home loan weekly, it's probably not going to be beneficial. It's going to be hard to do. But if you're paid weekly, you should be paying your home loan weekly as comparison to, that's what I always recommend. As a licensed broker, I like to recommend to stick cash flow. It's the same as your pay cycle. Okay, so the next one is the budget. So there's 2 things to a budget. With a budget, if I'm sitting down with you today, I'd be asking you, do you want to work out how much income you need to replace on your budget today? So that is with the mortgage, that's with the kids, that's with all that sort of stuff. Or do you want to work on a desired budget of where you want to be in 10 or 15 years time? So I don't know, say you're 45, you want to retire at 60. Let's work on a budget on what you want to retire on. Of course, it's in today's money, but let's work on a budget of what you want to retire on at age 60. With these guys, they wanted to retire at age 50, so their kids are still part of their life at that point, or they always are. But they wanted to do a desired budget. So with these guys, I've done a desired budget of where they want to be. But of course, you can just use your budget of where you're at today. So let's go through. So first thing you've got is your essentials. So your essentials are things you need, definitely. And of course, the first one's food. Now, with these guys, everything for these ones is monthly. So that's $1,400 per month for food. You've got utilities. With those guys, it was $450 for utilities. Then they've got schooling because their kids are in private school, which is great for some kids. Then you've got car expenses. So depending on your fuel usage and whether your fuel is part of your work, whether you have a work car or whatever it might be, that's going to change dramatically. That's $800. Then of course you've got life insurance. To me, that is an essential. It might not be to everybody. And health. A lot of people don't have health insurance either. Everyone to their own. You know, I mean, it's totally up to you when it comes to stuff like that. So that's what we would call 300 and 350. That's what we call essentials. But then we've got your luxuries part of your budget. So because this is a desired budget of 10, 15 years time, we need to put in luxuries, because if you want to replace income and stop working, there's no point in doing that if you're just going to stay at home every day. So with luxuries, that's got to include a few more things. All right. So with luxuries, we're going to add in holidays. That's $500 a month. Now that of course is an allowance. So you put that into a bank account. If anyone has read The Barefoot Investor, I'm not a huge fan of it, to be honest, because they make you do up, 10, 15 different bank accounts. And when you go into apply for loans at the moment, banks don't actually like that. But his philosophies and his basics that guy teaches, I forget his name, is good. It just gives you an idea of money. So if you're no good with money, you're terrible with money, go read The Barefoot Investor. Obviously change to his system for 12 months and then rejig it down the track. Don't stay like that, because banks don't like that bank account setup. Okay, so you've got Christmas and birthdays. Everyone forgets that. Birthdays are important. $800 a month. Entertainment. The entertainment, obviously, a lot of people haven't been spending much on entertainment in a lot of Sydney-based suburbs over the last couple of weeks, which is unfortunate, but entertainment's there. So that's $800 we allow for that of each month. That could be movies, dinner, whatever. And then, of course, I actually put in here miscellaneous. Now, miscellaneous could be anything, and that's why I whack it in there. I put in $2,000. It's a relatively big figure because what these guys wanted to work off was $100,000 per year net income. So what that works out to be is $8,300. That's where they want it to be, $8,300. I hope you guys can see that all right down the bottom. So that's basically $100,000 per year, and that's net income, okay? So we still got to add tax to this, okay? So when you're working out a budget, obviously you can go into a lot more detail than this. You can break it down to phone, power, internet, Netflix, I don't know, what are they called? Prime, Disney, Stan, all the other streaming services you have now, Foxtel, if you still got that. And holidays, Christmas and birthdays can be separate. Entertainment, you can break down to eating out, to movies, to whatever. And miscellaneous, you can break that up a little bit more as well. Because I do allow $2,000 a month for miscellaneous, because money in some people's lives just goes missing. It happens to everybody. It might not happen every single month, but you get your expensive months with, especially if you've got kids, you get months that just blow out with costs. It could be soccer registration for a rep team that come out of the blue. So when it comes to a budget, and I apologise for my messy writing, I should have been a doctor, but that should give you an idea of how I break a full budget up, just with the basic stuff. But feel free, you can break that right down into a lot more detail. Like even with car expenses here, you can break it down: fuel, rego, insurance. Like, you know, if you go on Google, there's so many budget sort of templates you can use. But this is just, I didn't want to bore you guys for the next hour completing a full breakdown budget. And honestly, most people, that's a bit overwhelming to do that as well. So let me wipe the board again for you. So just remember $8,300, which is, I'm going to write over here. Hang on, I'll just write over this. $100,000 net. That's what we're working off. So then I'm going to show you how we work backwards from that. Okay. It's very important we get these basics right before you go too far with investing. I really love it if young people can watch some of these videos I do. I learned a lot when I was young, but a lot of my mates and friends and family didn't, and some of them are still struggling financially. So, okay, the next thing I'm going to do. So with these guys, they need $100,000 net, right? So that's what we've got to work off. $100,000. And that's net. Now I'm going to work this out for singles and for couples. I'll just grab my notes, sorry guys. It's a bit hard to remember everything. Okay, so if it's a couple, obviously it's $50,000 each. And when you add tax onto that, it basically means you need an income. It's about $26,000 in tax. So each person needs an income of $63,000 each. That's taxable income. Oh, taxable. So that's $126,000, okay? That's what they need for return on their investment. Now, depending on how old you are, that could include super or whatever, but for these guys, it was $126,000. Now, if you're single and you want the same figure, obviously you don't need the same figure if you're single, but some people do. Some people want to have a much nicer life. So with that, with the single side of things, where are we? Sorry guys. With single, if you're single and you want $100,000, basically though, because this income is split, now a good accountant will tell you to split your portfolio returns because of this only going to pay $26,000 in tax. If you're single, you're going to pay around $45,000 in tax, all right? So that's $145,000 you need to get returned to have the same net income as a couple. So feel free to go. So if you're a non-active investor, if you remember, we worked on a 5% return here. So guys, if you're a non-active investor, what you've got to work off is work these figures. Oh, hang on. Work these figures backwards to see what capital you need to retire off this money, just working off of 5%. So for the couple over here, they will need net assets in their portfolio of basically $2.5 million. And this is if you don't sell your home to form part of your portfolio. And it's also, I forgot what I was going to say. That's okay. And then you've got the single guy or girl. They need $2.9 million to get a higher return on investment, 145, but to achieve the same net income as this couple up here. So this, if you get a 5% return on either of these, whichever the scenario that you guys are in, if you get a 5% return, that's going to give you an income of 126 and 145. Like in the current climate, a 5% return in property, it's easy to get. In say cash or etc. is very hard to get. Even the share market's a little bit hard to get at the moment in stocks, but it's going to be, but you've got to think, it's not always going to be low interest rates the way we're seeing it today. So always, when you do have your money invested, always diversify it correctly so any change in any market, you're not going to get hurt across your whole portfolio. So that's if you're what we call an inactive investor. Now, an inactive investor, like I mentioned before, is someone who just wants to sit back, relax, and just let the income stream come in. And they might just go to the cafe, they might go on holidays, they might spend more time with their grandkids or kids, whatever they might be. Now, that's what we call an inactive investor. Personally, I'm not an inactive investor. I'm a very active investor. Otherwise, obviously, you wouldn't be watching me tonight. As an active investor, I don't need anywhere near this figure to be able to achieve these returns, because an active investor gets a much higher return on investment than 5%. So say, for example, one of my cash flow strategies we put in, I think we've put in approximately $13,000-$14,000 last year. There's two parts to that cash flow strategy, and I think already we've made our money back, our $13,000-$14,000 back, and that's a 5-year cash flow strategy. So I'm going to get way over 5% return. The only downside of the cash flow strategy is you don't own the asset, so you don't get the benefit of the growth out of it either. So, but we teach different forms of property investment that relate to your own comfort zones, because you're going to be comfortable with your investment choices, and whether you want to be an inactive investor or an active investor, that's totally up to you. Many people change from inactive to active as they grow within their portfolio over 10, 15, 20 years. So guys, that's what I had for you tonight, because I really want you to work out to calculate your net worth of what you can and can't do, where you're at today, where you want to be. So then as we go throughout the year, you're going to be able to realize what you have to do, what you have to put in place to make it all work. Now, next week, guys, and I did jump a bit early today and I went live on the wrong Facebook page as well. I think I went live on my personal page before, but it's definitely 7:30 every Tuesday, except for Australia Day. Australia Day, we're going live on the Wednesday, not the Tuesday, but it's 7:30, not 7 o'clock, because it's a bit hard to get everyone at 7 o'clock, especially my Queensland clients, because it's only 6 o'clock up there. So next week, I actually forget what we're doing next week. Jesso, can you just put in the comments what we're doing next week? Do you remember? Actually, next week, I do remember. Next week, we're going through how to borrow money. Everyone who's gone for money in the last, applied for a loan application in the last, say, I'm not sure, probably 2 years, at least 1 year, they would have realised they're being asked to provide documents they don't even have. So what I'm going to be doing is going through how to structure yourself financially. Like I mentioned before, the Barefoot Investor, great guy, great ideas, but the way he wants to structure the savings accounts, it can be a bit of a nightmare when I'm trying to apply for a loan. So I'm going to be going through what to be careful of when applying for a loan, how to prepare. So most banks want 6 month statements in advance. So you want to be 6 to 9 months in preparation if you think you're not going to get approved. So just watch your spending. Zip pay and afterpay, like I said before, they are one of the biggest problems we face, because they don't have, to my knowledge, they're very hard to obtain statements from. Banks really don't like them, and it's just very hard to prove if you owe any debt or not on there. So guys, thanks for watching tonight. So there you go, Jess. Next week is how to set yourself up for loan approval. So I want to make sure I give advice, especially for my self-employed members out there. I want to make sure they understand what to do with the tax returns as well when it comes to borrowing money for cars and trucks, etc. like that. So guys, thanks again for watching tonight, and I look forward to seeing you again next week. If you ever want to have a chat, Jess is going to pop in a 15-minute Calendly link, which goes straight to my calendar. Whether we do it now or a bit later on, you can click that link, book in a 15-minute call, and I can just go through any questions you've got. But you can feel free, you can post questions in the comments on this actual live, or better yet, you can actually post questions, real questions, in our Facebook group. And if you do that, we'll answer them over the 24, 48 hour period. All right, guys, thanks again for watching, and I look forward to chatting with you again next week.